Gary Gensler, the chairman of the U.S. Securities and Exchange Commission, SEC, has explained his view that all cryptocurrencies other than Bitcoin should be considered securities. Gensler believes that the SEC has all the legal tools necessary to regulate the cryptocurrency industry and that almost all cryptocurrency transactions are already within the jurisdiction of the SEC. The only exceptions, according to Gensler, are spot transactions in Bitcoin and the direct purchase or sale of goods and services using cryptocurrencies. Gensler's argument is based on the idea that most cryptocurrencies are structured in a way that involves a middle group of individuals or entities who control the tokens and are expected to generate profits for token holders. These middle groups are often set up in tax havens or other offshore locations, making it difficult for regulators to oversee their activities. However, Gensler believes that regardless of how these tokens are structured or where they are located, they should still be considered securities because they are being marketed to the public based on the promise of profit. Gensler's comments reflect the SEC's increased focus on the cryptocurrency industry, which has been growing rapidly in recent years. The SEC has been stepping up its enforcement efforts against unregistered initial coin offerings, ICOs, and other cryptocurrency-related activities that it believes are in violation of securities laws. Gensler's remarks suggest that the SEC is likely to continue this trend and will be closely scrutinizing all cryptocurrency tokens that are being marketed to U.S. investors. Overall, Gensler's argument is likely to be controversial among cryptocurrency advocates who believe that the industry should be subject to less regulation. However, his comments reflect the SEC's view that cryptocurrency tokens should be subject to the same level of scrutiny and oversight as other securities in order to protect investors and maintain the integrity of the financial system. Following Gensler's claim that all crypto tokens other than Bitcoin are securities, a number of people took to social media to disagree with the SEC chief. Lawyer Jake Chervinsky tweeted, "Chair Gensler may have prejudged that every digital asset aside from Bitcoin is a security, but his opinion is not the law. The SEC lacks authority to regulate any of them until and unless it proves its case in court," Chervinsky emphasized, adding that this must be done for each asset, every single one, individually, one at a time. Logan Bollinger, another lawyer, similarly said on Twitter, "In this country, judges, not SEC chairs, ultimately determine what the law means and how it applies. That doesn't mean his thoughts are irrelevant. They're just not dispositive." For now, the SEC has emerged as the industry's primary civil regulator, whether crypto advocates like it or not. But there are still plenty of big questions about what the agency has been up to in recent years and what its current enforcement strategy will actually achieve. Arguably, the federal government's actions, including those of the SEC, didn't do much to prevent the loss of trillions of dollars in value over the last year, potentially impacting tens of millions of Americans who hold crypto assets in some form. Gensler has said that the roadway or runway for crypto firms that are not registered with the SEC is getting shorter, but the metaphor is an odd one. The planes are already in the air, so the agency is really trying to ground them. That explains a series of significant moves by the agency since the start of the year, including a major enforcement action against two prominent crypto firms based on an unregistered crypto asset lending program. A recent settlement of the crypto exchange based on an industry practice known as staking, and notice of a potential enforcement action against a stable coin issuer whose product is affiliated with Binance. Gensler broadly referred to these kinds of firms, which seem to differ endlessly in their offerings and corporate structures, as storefronts that are providing services to the public in a way that's commingled and is rife with conflicts. He argued that many of them combine functions that would have to be legally disaggregated in traditionally regulated markets, including roles that would ordinarily be separated among some combination of exchanges, lenders, market makers, broker-dealers, investment advisors, and custodians. On its face, the idea that an increase in SEC registrations and filings from crypto companies will somehow markedly improve the integrity and resilience of this market seems dubious. Last February, the crypto lender BlockFi agreed to register with the SEC at the agency's urging, paid a $100 million fine, and then went bankrupt in November. The stark turn of events seemed to reflect, at least in part, the fact that the underlying crypto asset class is both novel and unstable, and that this is not an industry with consistent and widely accepted valuation, marking, or disclosure conventions. Perhaps more importantly, the implosion of BlockFi seemed to reflect the legal and practical limits of the SEC's strategy to force more crypto firms to register with the agency. That is because companies that register with the SEC may have to satisfy more detailed and burdensome disclosure requirements, but that does not mean that those companies or their business models will magically become more stable or financially sound. The unstated premise of the SEC's current enforcement push appears to be that if the government can broadly stigmatize the industry and market participants, then ordinary people, the retail investors all over the world who have gotten swept up in the crypto frenzy of recent years, might think long and hard about whether to hold these assets in any form. It is a message that federal regulators recently delivered directly to the banking industry, warning them not to issue or hold any crypto assets because doing so would be highly likely to be inconsistent with safe and sound banking practices. Overall, there are still many big questions about what the SEC's enforcement strategy will achieve and whether it will be effective in preventing further losses in the crypto market. What do you think this means for Bitcoin? Are we going to see a rally based on this news? IRA allow you to save for retirement in a tax-advantaged way for greater financial security with lots of tax advantages. But most IRA offer the same boring stocks and bonds. Introducing iTrust.capital, the #1 crypto IRA platform in America. iTrust.capital allows cryptocurrency investors like you to enjoy all the exciting benefits of tax-advantaged retirement accounts. It combines the traditional IRA with the new, exciting world of cryptocurrencies. Why should you use iTrust.capital? It is the best crypto retirement platform in America, with some of the lowest fees of any cryptocurrency IRA platform. It gives investors adequate exposure to some of the top cryptocurrencies like Bitcoin, Ethereum, Cardano, Solana, and Polkadot. You can buy and sell all your favorite crypto assets while enjoying amazing tax-free gains. It is adequately secured by Coinbase custody with a $320 million insurance to protect against theft. You can easily roll over an existing retirement account or begin a new one when you register on iTrust.capital. iTrust.capital is the trusted crypto IRA for many American investors who love the crypto industry. To join the millions of Americans who use the platform, please click on the link in the description box below. Let us know what you think in the comment section below. Also, try to give us a like, subscribe, and turn on notifications. Thanks for watching.